What's up, opportunity cost investors? What do Tommy Bryson, Ryan Scribner, Bruce Wang, and Daniel Pronk all have in common? You do not know their rates of return, and in this video, we're going to prove it. All four of these guys dropped $100,000 stock portfolio updates within months of each other, and have already reviewed Tommy Bryson, Ryan Scribner, and Bruce Wang. In this video, we're going to review Daniel Pronk and show you why you don't know his actual rate of return, and we're going to show you ways that he can improve so that way you can. Now, why is this important to you? And that's because if you watched all four videos, Ryan Scribner, Tommy Bryson, Bruce Wang, and Daniel Pronk, how would you know which investment strategy you should use to make you the most amount of money? For example, if one can continuously make 15% returns and the other three only made 5%, wouldn't you want to listen to the 15%? I would think so, right? However, without knowing the returns, we can't make those decisions. So that's what we aim to do in this video, is to show you how they can improve so we can get the information and make the best decisions. But I'm kind of in a bad mood today, so I'm going to start the lightning round early. Cue lightning!
And what you'll see a lot of people do is say, well, the S&P 500 is up about 50% from its March lows. So if your portfolio isn't up nearly 50%, then, well, you're not beating the market. And I personally do not believe that this is an accurate way to compare your portfolio versus the S&P. And the reason is because I have been adding money to the S&P as I have been making money off YouTube and through my other sources of income. So essentially what I am trying to say is that I have been adding money like here, 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 here. So I have been putting money into the market all throughout this run as I have been getting more access to capital. So to compare my entire portfolio versus the March lows simply doesn't make sense because I didn't have all of the access to all of the money that I have right now during the March lows. So since I wasn't able to deploy all of my money in the March lows, why would I compare my portfolio to the March lows?
Yes, I extol Pronk's work so much, and I super appreciate the fact that he said most people make this mistake. Including himself. Now let me explain my accusation. All the returns he uses in his portfolio update are total returns. All a total return is a simple calculation where you divide the gain or the loss by all the contributions that were made, inadvertently doing exactly what he tried not to do. And before I show you the math and prove to you that total return isn't the one you want to use, let's just make sure he's using total return. So my editor over here is going to put the gain that he made on his spreadsheet, which he said is the most accurate, which is $30,000 and change. Divide that by all his contributions, which is $82,000 and change, and you're left with 37.5%, which is the same percentage he used on his spreadsheet. Now let's go into my spreadsheet and show you why total return is muck. All right, here's the lowdown. Let's say you started a portfolio, the first available date you could on December 31st, it'd actually be a little earlier than that, with $1. Throughout an entire year's time, it increased, and by the end of 1 year, you had $50,000 with no other contributions. Holy cow, what a performance, right? You're looking at a 4,999,900% return. And if anybody knows how to make that, leave me a comment in the description below because I would love to hear it. Now let's pretend for a second, on the last available moment, you deposited $200,000. It had no time to compound, it was just thrown right in there. According to total return, you would take the gain, so $49,999, which is how you went from $1 to $50,000, and you divide it by all the contributions, which is $201,000. That would mean your total return is 25%, ludicrously off from this 4 million, almost 5 million% actual return that you made. And it works both ways, not just in appreciation, but also depreciation. So I'm going to bring you to my second spreadsheet where I show you what if you started with $50,000 and it went down to $1, like this, 50,000 decrease, and now you're at $1. You had a negative 99.998% return, almost a negative 100% return. Terrible, right? But if you look at the total return, you take the difference, which is negative $49,999, which I got from ending balance minus the beginning balance, and divide that by the total contributions, which is $250,000. The total return is negative 20%. Wildly off. We can't use total return. And the reason why is because total return assumes that all the contributions were made at the very beginning of when you started the portfolio, which is wrong. It takes out the time value of money, which we need. There is a silver lining though. Because if you started two portfolios with the same beginning balance at the same time, made the same contributions and withdrawals, they had the same fees, all conditions are equal, then no matter what returns you use, you could just look at the ending balance, right? So the question becomes, do we have this ability in his portfolio update? And I have a feeling you know where this is going. All right, so according to his spreadsheet, his beginning balance is $82,534.90 Canadian. Just like we said before, the S&P 500 ending balance that he had on Yahoo Finance was $65,296.16. Subtract then the gains that were made, then convert it to Canadian dollars, and you get a beginning balance of about $77,276.54. Not the same. All right, so now let's look at his Apple portfolio on Yahoo Finance. Take his ending balance, which is $75,198.02. Subtract out the gains and we should get the beginning balance. We convert that to Canadian dollars and we get $76,768.99. This is not the same as the S&P 500, albeit pretty close. And it's not the same as the beginning balance of his actual portfolio. So I'm guessing he made his portfolio and then set up the benchmarks, which makes a difference and then makes it not synonymous. You actually can't compare the actual portfolio with any of his benchmarks. Now at this point, you're probably like, man, cool, you're being a dislike troll to him. And I'm not. And the reason why I have to say all these things is because I want to see the finance community improve. I say this in every video, and I really want to reiterate that I'm not saying you're wrong, or pointing fingers. They say you point finger at someone, you point three at yourself. What I want to show are ways that we can improve these portfolio updates so we can get the information we need, so we can provide the value to the audience. And usually I say that right before I jump into more things that are wrong with the portfolio update. And this is no different. Let's go. So Yahoo portfolios aside, we're looking at his actual spreadsheet now, and I still have so many quirks with it. One thing I do want to point out is the fact that he used average cost per share, which is so common in the investing space. However, average cost per share is meaningless to us. And the reason why, I'll go into more in depth on a different video, but very quickly here, average cost per share only tells you one of the two components we need in any metric, and that's cost. You also need the time, because there's a time value of money. Therefore, that entire column is useless to us, and I understand why people would say it. But again, you can remove it, and you would actually have a better portfolio update than the one you have now. And I'm pretty much done with this spreadsheet because there's not really anything it tells us. So I just moved on to the rest of the video, and one thing really struck out, and that was when he used a chart to show the performance between the Nasdaq and gold.
I also want to show you all this chart right here, which compares the prices of gold versus the returns of the Nasdaq. This top line right here is the price of gold, and obviously this bottom line is the returns of the Nasdaq. And as we can see, since the year 2000, gold has now returned about 600%, versus the Nasdaq's about 130%.
First thing, charts are a terrible way to demonstrate performance. One such example is he used the chart between investing in Nasdaq and gold, but he didn't include the dividends reinvested with the Nasdaq, which would have made the Nasdaq closer to 250%. And I know what you're telling me, yo, gold still outperforms with the dividends reinvested. However, I gotta tell you, these charts, and looking at it in this fashion, falls victim to the same pitfalls that the total return has. And that is, this chart only works if you invested all of the money one time in the beginning of year 2000, which he showed in the graph. And that's not usually what happens. In fact, in practice, what happens is we start with an amount and we continue to contribute to it. So this chart is a more accurate representation of the performance between Nasdaq and gold. And that is, you started with $1,000 and you continued to contribute $1,000 every single month into the Nasdaq and into gold. And in this scenario, Nasdaq more than doubles gold. This is a better way of looking at it. In fact, there's more that I can go into this, but I'm going to save chart analysis for another video, which I'm super excited for. All right, Jesse, cool it. We know you're in a bad mood, whatever. Okay, so I'm going to show you ways Daniel Pronk can improve his portfolio updates so we all can get the information we need. Because it's also important that he knows his performance, so that way he can know to keep doing what he's doing or to invest in the S&P 500 and us too, right? So the first thing I would do is go on my website and download the money weighted rate of return template. By the way, All the Excel sheets I mention or use in videos are linked in the description for you to use completely free. There's no emails you have to sign up. It's just, I put it in a Google Drive and I give you a link, so it's yours. I don't need to make money from it. I would use that template to provide all the contributions and withdrawals, any fees you made, any changes to the portfolio in a time-based way. So you would say, January 1st, I did this. January 2nd, I did this. This is a better way to show what your portfolio actually does. Another thing I would stress is the fact that you want to include tax implications to show how tax efficient your portfolio is. Because even if you can outperform the S&P 500, what if it involved you buying and selling and created a tax burden that made you actually underperform the S&P 500? Or Apple is another benchmark you use, just benchmarks in general. And the last thing I want to include is the fact that he should also have asset allocation, which I hammer down on each of these portfolio updates because it makes a huge difference, and is a video coming as soon as I can make it. But people keep producing $100,000 stock portfolio updates before I can get to it. Lastly, I just want to thank every single person who's made it up until this point. I really appreciate the fact that you're willing to listen to this, because I am just so mad at myself for not being able to get faster and louder at what I need to tell the financial community. I need this information out so we can make the best decisions. And I feel like I'm failing right now, but I'm trying my hardest to get to the point where we can help all those people succeed. So thank you everyone for watching, and until next time.